Natural gas futures failed to sustain the prior day's gains, instead sliding ahead of what is expected to be another smaller than normal storage withdrawal in the upcoming government inventory report. A Reuters survey of 17 analysts produced a range of withdrawal estimates from 61 to 95 billion cubic feet, with a median of 79 billion cubic feet. For comparison, the EIA recorded a 126 billion cubic feet decline for the same week last year and a 5-year average decline of 98 billion cubic feet. The overnight weather data was little changed but did hold a relatively cold pattern over much of the U.S. the next 15 days. However, the pattern is not as cold as the data showed late last week, and with surpluses in supplies increasing to plus 350 billion cubic feet, this has led to selling again today, with bulls hoping to defend $2.50 on April contracts. With little help from cold weather, Analytics Group is looking for production to drop under 100 billion cubic feet per day and balances to further tighten for storage surpluses to materially improve. It helps that Freeport LNG has been showing flows of more than 1 billion cubic feet per day in recent days. However, as with any liquefied natural gas facility's return, there's some variability expected. Once back at full operations, the Freeport terminal can take in 2.38 billion cubic feet per day. Meanwhile, pipeline nominations continue to point toward weak production in the Permian Basin and the Haynesville Shale. At least some of the decline in the Permian can be tied to pipeline maintenance restricting gas flows, though several producers in the gassy Haynesville have announced a pullback in activity in response to the lower price environment. Simply put, for current surpluses of 350 billion cubic feet to be erased or meaningfully reduced, it will take a prolonged period of stronger than normal temperature-driven demand, as well as a much tighter balance. Looking at the technical drivers in play for Henry Hub, the bullish upside implied by the 95% confidence interval relative to NYMEX natural gas futures is 248% greater than the corresponding downside risk. During the winter months in particular, the upside is particularly pronounced with upper bound confidence intervals above $12 for winters 2024 and 2025. Notably, analysts pointed out that this tremendous upside is despite risks for storage to fill to the brim during the coming injection season.